Hey guys, Whitney here. Welcome to the Passive Investing Made Simple Bootcamp. Today, we're going to be talking about how to track your passive real estate portfolio. Now, before we get started, we do this bootcamp every single month to help you build a skill as a limited part investor so you can go into your next deal with confidence. And so if you haven't done so already, make sure to check us out at passiveinvestingwithwhitney.com. There, you're going to get access to our priority access to our open deals. You'll be able to see our real estate debt fund. If we have a car washes open, you'll see those. Currently right now, we've got the debt fund. We also have our promissory note for medical offices, and as well as our preferred equity fund. But you also get amazing education. We look to make sure our passive investors are well educated in this space. And again, check it out, passiveinvestingwithwhitney.com. Now, if this is the first time that we're meeting, welcome. I'll tell you a little bit about myself here in a minute, but really what today we're going to focus on those biggest myths that investors tell themselves that keep them sidelined and not actually able to pull the trigger on a passive investment. We're going to learn what metrics you should be tracking for performance and to understand your balance allocation. And I'm going to show you the different variables you should be tracking initially so you can make some informed decisions on your portfolio. Now, I'm going to let you in on a little clue. Most people think of tracking their portfolio as an afterthought. The time to start tracking your portfolio is before you make the investment. Yes, I said that. Before you actually wire that check in, before you have signed your PPM, that is when you need to start tracking that particular investment in your portfolio to understand how it affects your balance and allocation. All right, now that I've spilled the beans, let's back it up and actually show you how to get to that point. But I want to bust a couple of myths right now, just right out of the gates. Most investors that are trying to look at passive investing in real estate, they tell themselves, I have no control, right? This is the whole reason why I stay in stocks, bonds, and mutual funds. I have the illusion of control with liquidity, okay? I actually argue the fact when you learn how to be a solid passive investor, limited partner investor, you actually have far more control than you did investing in the stock market. Why is that? It's because you fully understand your goals, your risk, your timeline. You know in and out these operators you're investing with. You understand the markets you're going into. You understand the deal. And guess what? You're tracking your own returns. So you actually know what you're making and can make informed decisions. All right. Now, again, if we haven't had the opportunity to meet, again, my name is Whitney Elkins-Hutten. I actually started off real estate investing back in 2002, completely by accident. Bought a house with a significant other. About a month later, the relationship fell apart and I had a house. And learned a lot on that transaction. Learned how to do drywall, electrical, plumbing, a lot of things that I probably shouldn't be doing. But 11 months later, sold the property and actually made more in that one transaction than I did at my day job that often had me traveling 80 hours a week. And I was completely bitten by the real estate bug. Since then, I have scaled, done over 5 million in flips, live-in flips, and house hacks. I have done, scaled almost 40 unit single family rental portfolio, purchased multifamily buildings on my own and in partnership. Have raised on 26, actually more than 26 co-syndicated deals, but also have been general partner on 10 of those deals. So I've done a lot in real estate. Now, I know that all sounds super impressive. Here's a little snapshot on what I currently hold in my portfolio, but the result is real estate, not my day job. Real estate has been what's been able to afford me to have 100% choice and control on how I spend my time. And guys, I actually love doing this. I was at the Investor Con conference last week. And if you've met me in person, this is what I love doing. You get me talking about real estate and passive investing, I will not stop. So I love doing this. This is where I love spending my time. And we can actually help you achieve this type of control and freedom in your life here at passiveinvesting.com. We have over 308 million deployed in our hard money lending arm through our real estate debt fund. We have 1.4 billion assets under management and very strong returns to our investors. Now, because we're going to be talking about math today, I don't want this to be construed as financial advice, legal advice, or tax advice. Okay, so before you take any decision, any of this math and say, okay, I've got the holy grail here, I don't need my financial advisor or tax advisor anymore. Make sure to take this all back to your investment team before making any investment decision. All right. And guys, since this is an interactive webinar, I want you to not hold on to your questions because you'll forget them. So make sure to drop your questions in the Q&A box. Our presentation time today is going to be about 30 to 35 minutes. And then we're going to have plenty of time for questions, chat, stuff like that. So again, here is your invitation to action. You can join me at passiveinvestingwithwhitney.com. All right, so let's talk about how to track your portfolio. And the first thing I want to help you understand is what does tracking actually mean? Well, if we actually look it up in the dictionary, tracking is to follow the course or trail of. It can be someone or something in order to find them or note their location on various points. Okay, now I put in a little graph over here on the right-hand side, a little picture, because that's exactly what we're doing is we're trying to find what is happening in our portfolio over periods of time. Now, here's the thing. This is typically tracking is looking at what's already happened, okay? Not predicting what will happen or mitigating all risk, all right? Now, I'm curious, go to the chat box. Let me know what kind of tracking do you currently do on your portfolio and with other assets? Tell me, I want to know, how are you currently looking at your portfolio tracking? Is anybody keeping a spreadsheet? Do you have software that you use? Maybe all you do to track your investments is read the monthly updates. Tell me what you do. I want to know. Because what I often run into is most investors, again, think of tracking as an afterthought. So they don't do much. Okay. Now the goal, somebody said, plain and simple, I look at Excel spreadsheets. That's cool. That's a step in the right direction. That's amazing. For me, my goal with tracking is also to allow me to stick to my planned investor thesis, okay? So I can make an informed decision, all right? And I'm going to show you what that means here in a minute. If you and I have ever worked one-on-one together, I'm really big about knowing exactly what your investment plan is. That way, when you go into an investment and we track it, you can understand how that is if you're actually abiding to your thesis ahead of time. Okay. Somebody said spreadsheet is the only way because it's so customizable. I think that too. Now, why is this so important? Because when we have consistent review, when we have a methodology, when we have a system in place for tracking, one, we get visibility on the asset performance. Okay. It's not a surprise to us when things are happening or not happening with an asset. All right. This can look like, looking at your monthly updates, looking at the financials. Okay. Your system could simply be taking all your monthly updates and, tagging them to a Google folder or a Gmail folder. And at the end of the month, or a folder with whatever email system you use. And at the end of the month, you read all the updates at one time. You sit down for an hour, hour and a half with your favorite cup of tea or cup of coffee, and you read through everything. You're looking at the asset performance. And you should be, because you are a limited partner. Okay. You are still a partner in the deal. Okay. You should be tracking this. One, asset performance. What's happening? What's not happening on the deal? Okay. How's the operator performing? Okay. Sometimes you can look at a profit and loss statement and, maybe you have a skill to bring to the table and you can point something out oh, I see that marketing, is, down in this particular area. You can ask questions, okay? But really what we're talking about today is on the tracking side of things. You're consistently reviewing your portfolio allocation, okay? Because if you're like me, you're investing, 1 or 2 times a month into deals. So if you have a system in place, a spreadsheet in place that you can keep yourself accountable, you're regularly visiting, now you're actually at your allocation compared to your investor thesis on a regular basis. Am I keeping to what I said I was going to, or have I deviated off and need to course correct? Okay. And I always use this example when a plane flies from LA to New York. Guys, go to the chat box. How often is it off course? I want you to put a number in there, a percentage number. How often is a plane off course when it flies from LA to New York City? A lot. Okay. I'm curious. Put a number to that. What kind of percentage? Just take a guess. Okay. I'm not naming names here. Okay. Nobody's being exposed if they get the number wrong. I'm the only one that can see the numbers, guys. Take a guess. Somebody said 60%. We got another person that said a lot. The plane is actually off course 95+% of the time. So how does it get from LA to New York City? It's because it's constantly checking in on where it is, it's pinging its flight path, and it's making 1% adjustments the whole entire time until it gets to New York City. That is like you tracking your portfolio. How often are you going to be 100% on? None, probably never. You're going to be so close, or maybe 1% off what your investor, what you have for your allocation, what you've set for your investor thesis, but you're checking in regularly, okay, to monitor the performance of that portfolio. Okay. And when we talk about monitoring the performance of the portfolio, again, it's more about you performing. Okay, we also want to see how the assets performing, the operators performing, but we want to see how you are performing with your investor thesis. And you also want to understand your risk exposure, your asset class. How much money do you have allocated to a particular asset class, operator, market, and deal? Okay, now I already let you know, I let the cat out of the bag. We want to begin tracking our portfolio before you make the investment. Why? Because this is your last double check before you sign that PPM and wire in the money. Will this investment get me closer to my goal, or does it pull me further away? All right. So let's start off with like some phases of like tracking. Okay. So this is you building your spreadsheet. These are some things that I would put into your spreadsheet. Number one, list your assets, everything you have. Okay. List the marketing name of them as well as the LLC that it's being held in. Why do you want to list both of those things? It's because tax time. You don't want to get a bunch of K1s that have all the LLC's names on it, and you have no idea which asset it is. Okay, let's get organized from the very beginning. So we get the asset name, we got the LLC attached to it. Hey, bonus points if you go ahead and hyperlink your PPM, the folder with all of your PPM assets and stuff like that, to that asset name on the spreadsheet. That's just going to make life a lot easier. Okay, put down the asset. Okay, asset address. Yes, I look up, before I invest in a multifamily or a car wash or even self-storages, I look up the addresses of these locations. One, I want to know that the deal actually exists. Okay, does that property actually exist? Okay. Now, the other reason why we want to get the address is because now that we can start aggregating some of that location data into markets. All right. But go ahead and note the address. Put in the date that it closed, right? So that's kind of the start date for your investment. All right. That way you can keep track of, hey, this operator said it was going to be a 5-year investment. We're in year 7. What's going on? Right. Hopefully you're going to, not look back and it be 2 years of gone poof, but now you can monitor, start to anticipate when your deal should be rolling out and can come up with a plan. Note the operator who you invested with. This is very important, right? We want to know what kind of asset you went into. We want to know the operator. We want to know the location. Okay, because those are the three of the four things that we're really going to get to control when we invest. Note the type of asset, the category. Is it multifamily, self-storage? Is it a fund? All those type of details. Put in the asset value. Okay. And then put in the distribution timeline. Okay. Also, note here, put in like how much you allocated to that. Okay. But, that's going to give us kind of like our base starting point for some of our calculations. All right. Now, the second phase of this is start tracking some of the returns. Okay. And I'll show you in my like kind of basic spreadsheet that I like using as an example. I'll show you what that looks like here in a minute. But you want to think clearly at the very beginning. Remember, you have goals already established. Do you need capital preservation, cash flow, equity growth, tax benefits, diversification? Okay, if you're plugging this deal into your tracking spreadsheet ahead of time, this is your last check before you write that check, literally. How does it meet your goals? Is it providing capital preservation, cash flow, equity growth, tax benefits? Okay. We want to make sure, again, this is our last check before we write that check, that this still will help us meet our goals. We're tracking our invested capital, all right? You're also going to take a note of what in the documents, in the PPM, that the preferred return is, what was noted as the ARR, IRR, and equity multiple. Okay, you're going to track all of that. You're going to note the hold time. Remember, we already noted when the date it closed, it's scheduled to close, but we're going to note the hold time, right? That way we can look every single year and go, oh, I've got $200,000 or $300,000 in multifamily cycling out this year. Okay. Have I heard anything from the operator? Do I need to get in touch with them? Are we selling this year? Are we not selling this year? What's the plan? Or if you do know, now you can start getting in touch with your accountant and be like, hey, I got $300,000 of assets cycling out this year. Let's come up with a plan so I don't take a big tax hit or anything like that. Okay. And then make some basic notes about the waterfall. What kind of split do you get? Is there other IRR hurdles, right? All of this is actually in your PPM, your operating agreement, your subscription agreement. Those nice long legal package you get from the operator, but go ahead and pull that information out. All right. I see some questions coming in. A lot of these I'll also tag like when we're going through an actual example of a spreadsheet. Okay. Somebody said, can you actually share your spreadsheet? I will show you an example. I suggest you take screenshots so you can do your own. There is power in you actually building your own spreadsheet and making it yours. Okay, there is a power there. But that's why I'm doing this webinar. So you know exactly all the things I'm tracking and you can plug these things in. All right. Now we got the basic information of the asset, we've got the returns. Okay, let's add some additional columns here. Okay, and this is where some people can get super complicated, or you can actually dial it back and make it super simple. Okay, but this is where we're getting into some of the math. One, maybe do some basic computations. Okay, this is one that I love doing. What is your percent ownership in the asset? Okay. Okay, this is just like for grins. Do I own 1%, 2%, 3% of the asset? Or, I've gone in on an asset and I own 30% of the asset. Okay, do some basic computation. So essentially taking your invested capital divided by the asset value. Okay, now you've got an understanding of your percent of ownership. Okay. Also computate your percent of net worth invested. Now, this is a absolute must, right? Because we already talked about you can control the operator, the market. Now we want to know how much net worth is allocated to your deal. Okay, in your investor thesis, you should have, before you invest in a deal, you should have a threshold, right? For me to sleep well at night, I can only have X% of my net worth invested in any one deal. Okay. Now that's going to be a different number for everybody. Now, guys, I want to know if you have actually thought about this number. So go to the webinar chat, put in that chat right now. Okay, again, only I can see this. How much net worth are you okay having in any one deal? Okay, and I'll read off some of the answers, and you guys are going to see how these things vary. Okay, who else? I got one person. One person's okay with having 10% of their net worth in any one deal. Another person is only okay with having 0.5% in any one deal. Okay, what are some other numbers? 2.5%. Okay, fantastic. Like for me, it's like 1 to 3%. Okay, like after that, I just don't sleep well at night. I get really nervous. Okay, we're investing in this in order to build a lifestyle. We don't want to cause stress and anxiety. So think about that ahead of time. All right. 1 to 2%. Okay, awesome. So as you can see, I wanted to make sure to draw that out. As you can see, investors, there is no right way to do this. This is why I don't share my exact spreadsheet, because I want you thinking critically about this. I don't want you copying me. I want you thinking through what works for you. Okay. Is it 0.5%? Is it 10%? Or is it some number in between? Okay. Other numbers to add here, add columns for the exit, okay? We talked about these numbers in the return section, okay? But make sure you've got them noted, because if you write them down now, what your this proposed IRR was going to be, and the proposed equity multiple, that's going to make it easier for you to track when the deal exits out. Did the operator perform or not? All right. This is very critical, because maybe at the end of the deal, you might be going into a 1031 exchange or proposed with a 1031 exchange. You have an opportunity at this point in time, even though let me back it up. You have an opportunity at this point in time to re-interview that operator and go, would I do business with them again? Okay. Did I like what they delivered? Now, sometimes IRRs, all these things are pro forma. They're the best guess. Okay. Sometimes we hit them, sometimes we don't. We love conservative underwriting where we hit or exceed them. Okay. Market conditions can also play into here. But did you get your distributions on time? Did you get your K1 on time? Did you get your monthly communication and financials? How did the operator keep you informed? Those are all questions for you to make notes here too in that exit column. That way you can now decide, do I want to continue doing business, or do I need to find a new operator? Okay. Pro tip, create an electronic file folder for your OM, your PPM, and your K1s, and link it to your asset name on your spreadsheet. Okay, this is just going to make it that much easier. For anybody here that's read my book, Money for Tomorrow, How to Build and Protect Generational Wealth, documenting where all your assets are and having them all in one location sheet so you can hand that over to maybe it's your spouse. If something happened to you, maybe it's your spouse that gets it, or an heir that gets it. Okay. This tracking spreadsheet also becomes that document. Okay. You have everything linked out. All right. It would be easy access for them. All right. All right. So now that we've got our whole spreadsheet put together, right? We've just been building columns per transaction at this point in time. Now it's time to get to analysis. And really, we don't want to overcomplicate this at the very beginning. I saw somebody in the very early part of the chat that they've got some financial software, 2 spreadsheets that calculates all these like really cool things. Okay. Some of us love numbers, some of us don't. I want you to go to the chat. Do you love numbers? Do you love doing math? Put it in the chat. I want to know. Okay. No, 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 heck no. I was born to love numbers. Yes, I love them. Yes. Okay. As you can see, most people, yes, to a degree. Most people are like, I don't really like numbers. So if you don't like numbers, if you don't like the math, we want to do two things. One, we want to make this as streamlined and simple as possible. We can always overcomplicate it. For those people who love numbers, you can overcomplicate until the cats come home, okay? But make it as simple as possible, okay? And let's make the spreadsheet do the work on the computations, okay? So simply what we're trying to track here is your overall exposure to any one asset class, any one operator, any one market, and any one deal, okay? And I'll show you just, how, I mean, really what we're doing is we're doing summation and division. That's it, okay? Now, I'll show you the spreadsheet here in a second, but if you haven't done so already, I keep referring back to an investor thesis. Make sure that you create your investing rules. What will help you protect and grow your capital, but also what helps you think, sleep well at night. So if you haven't done so already, if this is like a foreign concept to you, tracking your portfolio, go ahead and think like, okay, as we already designated here, somebody only wants 0.45% exposure to any one deal. Somebody is okay with 10% exposure. Think through that for any asset class, any operator you're with, any market, or any deal that you go into. All right. You want to have these rules in place ahead of time before you invest. That way the spreadsheet can allow you, can kind of help keep you in check. All right. Every time a deal exits out, we will also want to double check our investing thesis. Where do we need to move the numbers? Now, when I first did this for myself and I started kind of putting these rules in place, I discovered I was heavily weighted in multifamily. Like I thought, I was like, I will never have more than any 25% of my portfolio in any one asset class. Well, I had like 65% of my portfolio in residential real estate, largely in multifamily. And I had to think and go like, am I okay with that? So this doesn't have to be evenly weighted across all asset classes. Okay. Maybe you were on our call with Christina Suter yesterday. She likes thirds. But really you have to understand like the asset class as a whole. So for me, I was okay. I'm pulling back my multifamily weighting to about 45%. I'm allowing my deal exits to help me, transition that. But if I had never put together the tracking spreadsheet, I don't think I would have ever really known. I would have been taking a guess. Okay, here is my last caveat. Again, this is why I don't share my personal spreadsheet with people. I don't want, or in my investing rules sheet, I don't want, my rules may not apply to you. I'm going to say that again. My investing rules may not apply to you. Okay. So one person here might be in the accumulation phase. They're totally fine taking larger bets on assets, or maybe they're in the scaling up part of their portfolio and they have to do 5% of their net worth in every single deal until they gain some momentum. Somebody else here might be, towards like the cash flow part of their portfolio, maybe closer to retirement. And they're like, heck no, I would never have more than 1% of my, net worth in any one deal. And I would never think of going over like 5% in any one asset class, right? Some people here might love the stock market, other people don't, and they want to slide that into their portfolio as well. So make sure you think critically about these things for yourself. All right, guys, before we wrap up, I want to show you an example. So I'm going to stop the share here, and then we'll come back and open it up to some questions. Oh, I know what I didn't do. Hold on. Hold, please. Ah. There we go. I got to get it out of the presentation. There we go. Okay, now I can share my example. Okay, so here is kind of an example. Somebody's like, can I get the copies of slides and recording presentation? I'm constantly updating everything. I don't share my slides because like the next iteration, it just won't make sense to you. you can get the recording for the webinar on YouTube. It'll be posted in the next day or so. So you can have access to all of that there. As far as the sheet here, here's an example. I'm noting it right at the very top. Like, what do I want from my portfolio? For me, I'm looking for preservation, cash flow, equity growth, and tax benefits in that order. Okay, so every investment here, I'm gonna evaluate. Now, here's the thing. You might be like, hey, Whitney, I've already done like 10, 20 investments. I've never looked at it this way. Great. This is an amazing opportunity for you to evaluate what you've already done and then go back and plug that into your thesis. Okay. Now, remember, this is just an example of how I set it up. And I went ahead and highlighted, when you set up your sheet, the bright green is what you're going to need for certain. But yeah, you're going to put in, an asset. Maybe you're in a multifamily fund and the locations are all various, but hopefully they're going to be in one particular area of the United States, like the Midwest or Southwest or something like that. So you would note the market. You're going to note your timeline of closure, the type of asset class it is, the operator. Okay. I go ahead and put in whether I'm actively involved or passively involved in the asset, because I do still do active investing. The unit count, because I like tracking my unit counts, but maybe you don't want to do that, or you do or don't want to do that, up to you. But value the asset, okay, because we want to know how much of the asset we own, okay, and then my invested amount, we want to know how much of my net worth is invested in this asset, okay. Here's kind of the way, here's an interesting, puzzle piece, because maybe you set a rule that you only want to have 5%, less than 5% ownership in any one asset, but then you realize you're 30% ownership in that asset. Are you okay with that? That's why we want to track those two numbers. Okay. Here's a good example. A mobile home park in Missouri. Okay. Am I okay being 1/10 owner in this particular asset? Okay. Even though it's 5% of my net worth, 5% of, I have 10% ownership in one deal. Am I okay with that? Am I sharing the risk with other investors? Okay. I want to understand how it's meeting my goals, what my hold term is. Okay. I also track how I invested it, right? Am I investing with cash, through a trust, through an IRA? I'm making note of that as well. Okay. Again, I use my spreadsheet, totally to track all my assets. The preferred return, what was originally the preferred return? How is it being distributed? And then you're going to make note of your entry, IRR, equity multiple, exit IRR. Okay. Again, you're going to compare the exit IRR to the entry IRR. Like, how well did this asset perform? You're going to compare the equity multiples. Like, is this a deal that performed well? Do I like the asset class? Do I like the operator? Do I want to reinvest? And then you're making any notes. Okay. So again, this is kind of your base spreadsheet to start from. And then you can get down here and you can be like, at the varying asset classes, you can understand like how much you have totally invested, how much you control, how much your percentage of your portfolio is in that particular asset class, with the operator in the market. Okay, literally all you're doing is summating the columns for those particular asset classes and dividing by like your total net worth. And then from here, make sure you've got some investing rules set aside. Okay, now these are arbitrary. I just type notes. This is where you got to customize it for yourself. What are the things that you're just like, ooh, I would never have any more than 10% in any one asset class, because if things started happening with multifamily, I would be like so nervous. I wouldn't sleep well at night. Somebody else might be like, hey, I love multifamily. I'm totally fine. I'll have 30% in that particular asset class, or 40 or 50. All right. So that is kind of a base way to start tracking your portfolio. Guys, I want to open it up to questions right now. I know we've got some things that have come into the Q&A. One question, are you tracking projections and actuals? I expect, yes. Like if you notice in that column, I am noting what was noted on the pro forma at the beginning and then also at the end. Not necessarily to like, analyze total return or anything like that, but for me to like really evaluate, is this, somebody I want to continue doing business with or not? Okay. What's markets 1 through 4 and operators 1 through 4? Well, that I had to put in a placeholder. So, operator 1, is maybe you're doing a lot of investing with us here at passiveinvesting.com and you have 4 or 5 assets with us. You would label all of your assets with us the same. That way it's easy for you to tag and summate those columns or those cells in the spreadsheet. Markets 1 through 4, the same. Maybe you're tracking, I encourage people to track how much do you have invested in Texas, in the South, in the Southwest, in the, Southeast, right? Like in the various parts of the United States, because real estate is so local. Also, a couple different things. Like if you have 60% of your portfolio in Florida, okay, are you okay with that exposure? If like hurricane and flooding continue to happen in Florida, are you okay with that? If you have 70% of your portfolio in Dallas, Fort Worth, Texas, okay, that's a lot of like just single market exposure in your portfolio. Also, I had some investors that, had that, deep concentration in the Dallas, Fort Worth area whenever the power grid went down. And so it was pretty nail biting for them. They were like, oh my goodness, I can't have that again. Like I had some investors that maybe weren't so concentrated in one particular area, but they had like, some of their portfolio in Dallas, Houston, San Marcos. Well, all of Texas really got hammered with that storm a few years ago. Somebody said, I survived that. Okay, I did too. That was a huge wake-up call for me. I had over, I think like 35, 40% of my portfolio exposed to Dallas, Fort Worth alone. I was like, nope, time out. I can't sleep well at night. I need to change that exposure. Okay, so you want to get very granular here. Let's see here. My question is, I'm checking the site and it seems there's some real estate. Oh, so this is more about investing. Awesome. Okay, so somebody asked, I'm going to point this out. If you have a question unrelated to tracking your portfolio, reach out to me at whitney@passiveinvesting.com. I'm going to type my email back to you here. Your questions are very specific, to something unrelated to our conversation today around depreciation. So email me there. I'd be happy to like set up some time with you and we can work through those questions and because they're very personal. Like, how do you reduce your W-2 income? All right, guys. We have plenty of time. What other questions do you have regarding tracking your portfolio? I'm happy to, continue to share my insight here. My question to you, was this helpful? What kind of aha moment? I want you to go to the chat box. It's only when we start thinking about back of what we learned new today. Tell me your aha moment. What clicked for you? Did you learn something new? Is there something that you're just like, wow, I didn't have that in my spreadsheet before. I wasn't doing that. Now I see the case that I need to start doing that. Go to the chat box and let me know what those aha moments were. Anybody? Let's see. The tracking of percentage of net worth is not something I've ever done before. Thank you. Yes, absolutely. Track how much you need to know how much is being exposed to anyone. Remember, limited partners, and even general partners, we get nervous. I shouldn't say nervous. We can only control so many things, right? And we're trying to put control back in your hands. And you can control your goals, right? Who you invest with, where you invest, and how much money capital are you exposing to that deal, okay? And how much of that deal are you actually holding, okay? So we want to understand to track that, simple math, summation, division, in order to give you great clarity of what those risks and exposures are. Okay. Do you track cash flow and exit multiplier separately for a single investment? If it has both. Cash flow, you can cash flow, track cash flow. I kind of gave up on it. One is because you have to continue, you're tracking it every single month, which you should be, right? The other part of tracking here that I don't really dive into too deep is that you need to be making sure your distributions hit your account every single month. You get your update, you get your financial statement. That is huge. We have investors that will email us 6-7 months later and they're like, I switched SDIRA accounts and I haven't been getting my distribution. We're like, well, because you switched your account, you didn't tell us. So yeah, you should be doing all that, making sure you're getting the proper distribution, because it could flag maybe that you missed communication if you didn't get a distribution, or if your distribution's been lowered, or heck, maybe hopefully it's been a happy day and you got capital returned back to you, like through a refinance or something, right? Like you can now track that. But that's where it can get more complicated. So if you're one of those people that doesn't love numbers, don't make it complicated, right? Keep it pretty simple. But the internal rate of return and the equity multiple will give you a sense of the overall performance of the asset, and it's going to take into account the cash flow and your capital returning back to you, especially the IRR number. So if you don't like computing aggregated cash flow over 5 years, every single month, just check your bank account and make sure you're getting your distributions, and then track the IRR, right? Okay, because that's going to inform you your total return with the cash flow, as well as your money coming back to you. Do you track the communication performance of your sponsor and operator? Yeah, I do that under notes, right? So how I do that is I have like tagged Google folders. Like I use Gmail for my email, and I have tagged folders in there. And I tag it by operator. And so I send all emails, for that operator into a folder. And then I review that, like I try to review it once a week. Because, if a deal came out or if there was a special communication, I want to get that, but minimally one time a month. And I'm looking for those monthly updates. So at the end of the month, I'm like going through a quick, like little checklist. Did I get my distribution? Did I get a monthly update? Cool. Really quick. I have over 55 like private placements, almost 60. And so it takes me like 30 minutes. And guess what? That is a process you can hand off to somebody else to have them do. You can hire a kid, pay them, right? That would be the easiest way. Or you can have like a virtual assistant step in and help you do that if you build a system for that. Are you seeing some of your investments having paused distributions due to current capital markets? I mean, that's been going on like across, widely across multifamily and self-storage for, 12 to 18 months. So yeah, I mean, I think that is, we've seen cash flow compression. We've also seen, with the interest rates running up, yeah, like we're seeing that happen. But not all of my assets have paused distribution, but a handful of them. I make note of that as well, right? That way I'm keeping track, like this asset's on pause, this one's not. Also under that notes column, if something is supposed to do a refinance, or I have one asset in Colorado Springs that has had like a sewer line issue and distributions should restart in like October, I'm making note of those things. Okay. So again, you can make this as simple or as complicated as you want, right? If you're somebody who's just saving all of your monthly communication in your email, maybe you don't put that in your spreadsheet, right? Because it's all there and you can go back and look at it. Most operators have a portfolio and you can go back and look at it. For me, I do that because I don't want to go back and try to find and dig the email. So I will make small notes. And this is where I get a lot, sometimes, I get my VA involved and I have them, read through things and put together part of my tracking spreadsheet for me. And then I go back and just kind of verify. It saves me a little bit of time. Any other ahas that came up here? That would be fantastic. Again, when you share what you learned, it crystallizes the information. Okay, so this isn't something for that where I get like, it helps me understand like what's working and what's not working for you, but also it's a process to help you crystallize information. What parameters and their tracking in importance are your top 5 parameters for comparing investments? Okay, if I'm reading that correctly, one, the first comparison is always going to be, does this investment meet my goals? Okay. Which one meets my goals? Which operator do I believe in more? I know you're probably going, ooh, this is not what I expected. Which operator do I believe in more or do I have a history with? Okay. Which asset class do I want to be exposed to more? Okay. Again, that goes back to my tracking spreadsheet, right? Like if I'm already overweighted in one particular asset class and I, no matter if I found a deal and I love, 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 love that deal and I love the operator, I might not invest in it because I have a different investment thesis. I've already put down rules for myself. Now I get to choose if I break my own rules. I do. Okay. And I do time to time, but now I knowingly know if I do that. Okay, so it's shame on me, okay, not shame on them if something goes wrong. It was shame on me for violating my own rule. Once I kind of get past those things, then I'm, if I'm looking at the deal, I'm also like looking at what's my true exposure. One, my net worth in the deal, but also how much of that deal am I carrying amongst other investors? Like, am I 10% of the deal? Am I 2% of the deal? Okay, for that particular asset class and that operator, am I okay with those numbers? And then looking forward, I'm going to track everything, the IRR, the equity multiple, stuff like that. So I would I would kind of rewind because I tried to really think of, what could I strip out of a complex spreadsheet that everybody should be taking a look at and tracking. And those are kind of the thought process here. So would you prefer an investment in the right asset class over an investment with a better IRR? It depends. And you should, anybody that says anything other than it depends, has probably a different agenda. Again, like if we as limited partners, and that's how we're communicating here is as limited partners, is we want to, again, put ourselves in the control. So which balances your risk more, exposure into a particular asset class or exposure to a particular IRR? Okay. And a couple of people have noted they put things in the chat. I got a lot of questions to get through and we got plenty of time, guys. So we'll get to them. So I would say the tracking is to help us balance our performance and understand, okay? What you're actually asking about is if I have a deal in front of me, which deal do I go into? Again, it still depends. Like if you're looking at 2 different deals that have the amazing operator, you love the asset class, you love the market, you love everything about them, they all meet your investor thesis, everything about them is comparable and one has a 15% IRR, the other one has an 18% proposed IRR. One, do you believe the operator can actually hit those IRRs? Then yeah, maybe you go with the deal with the higher IRR, but there's so many other things before that to consider. Okay. Somebody has shared, percent of net worth is important, but I did not watch the percent with a particular sponsor. Got in trouble with that myself. We'll be tracking closer. Yep. Over 75% of deals under or overperform with respect to target returns due to different reasons. I would argue that's actually, I'm going to ask the question. How many of you have had a deal exit where the operator hit the exact IRR they proposed? Go to the chat box. How many people have had that happen? Never. Yeah, right. Never. It reminds me of the quote. I'm going to botch it. My husband loves the movie Anchorman. It's like 60% of the time, it works all the time, right? Like when they're talking about the Panther perfume. It never happens, right? The performer is the best educated guess going forward. Thought you guys would like a little bit of humor this morning. So the question continues, for underperformance sponsors generally blame the macro environment. And for overperformance, sponsors want to take the credit. Is there a clear-cut way to see through the sponsor's marketing messages? Ooh, I love that question. Right now, we are in a macro environment issue. I don't know many sponsors. Well, and just like even the 2 years before, like everybody looked like a genius whenever they sold a property and it like overperformed. So that is a great question. Let me sit with that for a second. Let me come back to that. Let's follow up on that on like a future masterclass, because I want to give that a little bit more thought. My gut, for me is that I'm always looking at, did they hit in the sensitivity analysis? Not so much the exact IRR that they were targeting for exit, but in that sensitivity analysis range, right? Because that is, that's where they should be looking if the market overperforms or underperforms. Like the run up before COVID, like everybody looked like a genius. Like the worst operators look like a genius. But now we're in the phase of the market where, great operators are worth their weight in gold. And did they, did they perform a correct sensitivity analysis? I would argue that most operators out there didn't. And two, operators are trying to reposition assets to get them to navigate through this market cycle. Okay. And so there's a lot of great work going on. Just, sit tight with that. Happy to answer follow-up questions on that. All right, guys, we could probably have time for a couple more questions. I see they went in the Q&A. What are asset classes that you will completely stay away from at this moment, assuming holding for the next 5 years? I would say any asset class that I don't fully understand. So the reason why I say that is I think there's always a case for, multifamily, self-storage businesses, cash flowing businesses, right? Like express car washes. Right now, I will tell you what I love is debt. For two reasons. One, it is an amazing time to be the bank. Amazing time to be the bank. And two, I'm not doing as many equity deals right now. So what am I doing with my cash? I want it performing. I can get it compounding right now. I can get monthly distributions right now. Real estate debt funds. We have a real estate debt fund. I absolutely love our real estate debt fund. If you want to talk about it, reach out to me at passiveinvestingwithwhitney.com or whitney@passiveinvesting.com. That's my direct email. This is a great time to park capital in a liquid environment. That way, when the next equity deal that you want to do pops up, you can liquidate and you can go. But yeah, I would stay away. I think for right now, this is how I know I'm maybe not answering your question as directly as you would want me to. But I'm looking at my portfolio and I'm trying to look at it and go, who did I invest with and what did I invest in that I didn't fully understand? Let me do what I can to either let those things cycle out, exit the deal somehow, right? I could potentially sell my shares to another investor, right? I've already done the hard work of the hold. right? Somebody else can come in and buy my shares, maybe at value or at a discount, and like make a lot of money a couple years later. I don't know that. How can I optimize my current portfolio? All right. All right. How can I get crystal clear on what my investment thesis is? Okay. How can I get my cash working for me today in a very safe and stable manner? All right. That way, in the next phase of my investing, which, guys, I mean, as soon as the Fed starts lowering interest rates, the spigot for deals will start turning back on in like 3, 4, 6 months. Okay. I read a report earlier this morning that we might be targeting a drop by the end of Q3. I don't know. These are all predictions. Everybody's got a crystal ball right now. So long story short, I'm looking at optimizing what I currently have. Is there somebody I shouldn't have invested with? Is there a place that I shouldn't have invested? Is there a deal that I didn't totally understand? That said, for me, I'm on hold with anything in cryptocurrency because it hits those questions, that I'm still trying to answer in my head. I think there's a case for almost any other asset class out there, for it to work in somebody's portfolio. Somebody said, I see you like to describe capital calls as a lot of good work. Ooh, I would love to have more clarity on that. Capital calls, if you saw, I would refer you back to the conversation I had with Dan Hanford the day after Memorial Day. We did a whole thing on whole episode on the masterclass to understand, do I invest in a capital call or not? And honestly, we took you through a framework on how to kind of decide whether investing, deploying more capital through a capital call is a worthwhile venture or not. It isn't always a worthwhile venture, guys. I will never blanketly defend capital calls. Okay. So, I've been part of capital calls that was throwing good money after bad. I've been part of capital calls where the deal was an amazing deal and I wish I had the money at the time to put into the capital call so I didn't get liquidated. My shares didn't get liquidated. And then I've had capital calls where it was just like right time, I had the cash, the deal still worked, it was going to perform and it made sense. Okay. So, that was Dan's rule number 1. He was like, if you get faced with a capital call, do you actually have the funds to participate? Because if you don't have the funds to participate, if you can't maneuver your finances around to participate in the capital call, if it just doesn't work, then it's a moot point whether it's a good capital call or not. Okay. But once you cross that hurdle, now we get into the real discernment of like that operator. Like, are they the ones to steward that asset? Like, what is the business plan? How is the market performing? How's the asset actually performing? Okay. And are you throwing money at capital calls that are actually going to just fee? I've seen a $6 million capital call that $0 of that went to pay down any of the principal on the loan. That's scary. And then I've seen other capital calls where it's like $6 million and like 4 or 5 million went to pay down the principal of the loan. Okay. Far less scary, right? So we've got to, it's not all or one. Like there's multiple shades of gray in here. We got to work through a framework. So I will redirect you back to that conversation. Amazing conversation that I had with Dan. It's posted on our YouTube page for sure. So you can check that out. Guys, we probably have, I have time for one more question here, and we have one that came in as a follow-up to the capital call. How can the sponsor respond to investors that won't support a capital call? Well, I mean, quite frankly, you don't have to do a capital call. I mean, I should say that. That is something that when you invest in a deal, you need to know in the PPM that you're signing, are you going to be required to go into the capital call? I haven't seen that, but I've heard that, or not. And if you choose not to go in, are you liquidated? Are your shares liquidated? Okay. Does the capital stack rearrange on you too? You know, if you signed a PPM and you're required to participate in capital call, I mean, quite frankly, the operator could sue for you to participate in the capital call, but you would know that ahead of time. Most of the time you won't, if you check your PPM, there's probably some sort of like liquidation feature, or you take a lower position in the capital stack, a riskier position in the capital stack if you choose not to participate in a capital call. That is their right. Now, if a limited partner is just not returning emails, you're not a good partner, right? The operator is noting that too. Okay, be a good partner, okay? Respond to the you know, if you get faced with a capital call or any sort of request from an operator, respond, okay? Ask questions, inform yourself, okay? Be the good partner. And then discern for yourself if it's the right direction for you to go, okay? But yeah, we can't actually make people respond to emails and to phone calls. I would like for that to be the case, but that's just actually not the case. But anyways, that would be kind of my 2 cents is, you know, if you're going to participate in a private equity deal, that is part of your role. Be responsive. Okay. All right, guys. Hopefully this was of value. I know we took a left-hand turn here at the end. If you guys want to learn more about or connect with me personally, you can go to passiveinvestingwithwhitney.com. Short little form there. Most of you probably are already on our email list because you're here live. Otherwise, if you would like, you can, you know, if you want more information, or if, you know, if we need to get a deeper question answered for you, if you want to hop on a phone call with me, reach out to me at whitney@passiveinvesting.com. Guys, take care.